In this video, we'll continue with deferrals and we will go to the next item, which is depreciation. All right. So in this scenario, it says the company purchased equipment for $7,000 and depreciation each month on the 31st is $700. So equipment is a deferral because you purchase the equipment at the beginning ahead of time, and then later on you use up the equipment. Okay, and when you use up the equipment, it becomes depreciation. Now, there's a lot of calculations that goes into how you come up with this $700. We're going to do that later in the course, but now what I'm just going to show you is how we go ahead and process those entries. Okay, so the purchase of equipment, and this is equipment, it could be buildings, is the same steps. It could be, so you've got buildings, you've got equipment, you could have technology or computers, you can have furniture and fixtures. So pretty much all of that would follow depreciation. If you depreciate all of these items, the only thing that is not depreciated is land. Land is never depreciated, or it's never used up. We don't say that as land goes on, as years go by, land gets used up. Whatever the land is, it stays what it is. But equipment gets used up, vehicles get used up, furniture gets used up, technology gets used up, but land stays the same. All right, so equipment was purchased for $7,000 in cash. We sort of went through this a few times, but I'll keep going back to it. Cash, right, goes down, so it's a credit. Equipment here is an asset. We received this, so it goes up, so that's a debit. So I'm going to go here, and I will do the journal entry for the debit to equipment for $7,000 and a credit to cash. So I'm going to put that in. So $7,000 here for my equipment, and cash $7,000 here is my credit. All right. Again, there's a lot of calculations that goes into depreciation, but we're going to do those later. So depreciation, what you need to know now is that the entry for depreciation is always the same. So depreciation each month is going to be a debit to depreciation expense and a credit to accumulated depreciation. And usually we do depreciation expense dash equipment if it's equipment, depreciation expense dash furniture if it's furniture, etc. But depreciation expense, and you credit accumulated depreciation. So I go over here and I put in my depreciation expense 700, and I have my accumulated depreciation 700. Okay, so notice that so here's what's happening. We're using up this equipment. Okay, and equipment used up becomes an expense, but there is no equipment expense. And notice we don't actually change this account. Let's go and take a look at supplies, right? In supplies, what happened? We used up supplies and we credited supplies, and we moved it to an expense. When we did prepaid rent, we used up the prepaid rent and we put it to rent expense, but we credited the prepaid rent. When we had insurance, we used up the insurance and we put it in insurance expense, and then we credited the actual account. So in prepaid insurance, in prepaid rent, in supplies, we actually credited or reduced the exact account. But when we come to plant assets, equipment, furniture, technology, building, vehicles, we don't do that. Notice there is no credit to the equipment account. What do we credit? We credit accumulated depreciation, and actually I should say accumulated depreciation equipment. We credit accumulated depreciation equipment, which is, if you look at your T account, you'll see here, you see those two stars? This is a contra account. It's a contra asset account. So on your balance sheet, you'll remember, what do you see on your balance sheet? You see equipment, the amount, and then you see less accumulated depreciation equipment. So you take the balance in equipment and then you minus the amount of the equipment that was used up. So basically this calculation is saying, okay, here's the equipment. How much of the equipment became an expense? That's your accumulated depreciation. And then you take the difference, and that's the net balance in your equipment account. And you're going to learn that a little bit later. But for now, these are your entries. So note, we do not credit the equipment account when we use up equipment. We credit this contra asset account called accumulated depreciation equipment. So these two accounts go together, right? These two are sort of mirror images of each other. Equipment tells us the initial balance for equipment. Accumulated depreciation equipment tells us how much of this equipment was used up, right? And that's what we put in depreciation expense. Again, the expense represents a using up of the asset. And this process is the same for for furniture and fixtures. It's the same for building. It's the same for technology. It's the same for vehicles.